Hey, how's it going, everyone? Zachary Jensen here, managing partner of TaxWise Financial Services, where we are empowering small business owners to maximize tax savings and grow with confidence. Today, I wanted to go over the top three game changing tax strategies for power couples to build wealth. In this video, I'd like to cover three incredibly powerful tax strategies for a husband and wife in varying scenarios to combine together and work as a team and really maximize their tax savings in a very, very positive and very, very serious way. I mean, I'm talking about not just ticky tacky savings here and there. I'm talking about saving tens of thousands, if not hundreds of thousands of dollars per year. So let's just jump right into it. Number one on our list is going to be the high W 2 earner and stay at home spouse power couple move with real estate. This is a great strategy for couples where one spouse has a high income from a W 2 and the other spouse has the time and interest to manage real estate activity while at the same time staying home and not having a W 2 themselves, whether they're spending time with the kids or doing charity work or that sort of thing. This arrangement leverages the IRS tax code to create significant tax savings while building long term wealth. High income tax professionals, such as physicians, attorneys, and executives who often find themselves in higher tax brackets, stand to gain the most from this strategy. Essentially, what we're doing is qualifying the stay at home spouse as a real estate professional under IRS Rules Section 469. Real estate professionals can't reclassify rental income losses from passive to non passive, and non passive losses are only deductible against non passive income, including W 2 income. But if you qualify as a real estate professional, we can now take these losses that were previously passive and offset active income, including the W 2 income, and create massive tax savings. To qualify as a real estate professional, the spouse must spend 750 hours annually participating in real estate activities, and more than 50% of the spouse's working time must be in a dedicated area of real estate called a real property trader business. Material participation is another requirement as well, which can be achieved in several ways, such as managing properties, meeting with tenants, and overseeing repairs. There's more to it, but the gist is you got to spend at least 500 hours in the rental activity or 100 hours more than anyone else. And then the status allows you to take rental property losses, including depreciation, and fully use that against the W 2 income. Then we can pair this with a cost segregation where we accelerate depreciation into year one, and that allows us even more depreciation to massively offset a W 2 earner's income. Let's go into the technical breakdown. Depreciation is a key tax tool in this strategy. When you purchase a rental property, its value, excluding the land, is depreciated over 27 and a half years for residential properties and 39 years for commercial properties. A cost segregation study accelerates this depreciation by identifying components like appliances, HVAC systems, and landscaping, which can be depreciated over 5, 7, or 15 years. And then with bonus depreciation, introduced under the Tax Cuts and Jobs Act, taxpayers can deduct up to 100% of qualifying assets in the first year, which is phasing out after 2023. This can substantially create paper losses that offset taxable income. Currently in 2025, we're looking at 40%, but we are seeing tax laws that could come up, bringing it back to 100 for later years. Now let's move into an example. John, earning $800,000 annually as a corporate executive, places him in the highest tax bracket, and his wife, Sarah, manages their real estate investments full time. In 2024, they've purchased a property for $750,000 and used it as a rental. A cost segregation identifies $200,000 in components eligible for year one bonus depreciation. John's taxable income is then reduced by $200,000, and assuming a 40% combined federal and state tax liability, this saves them over $80,000 in taxes. Meanwhile, the rental property generates cash flow and appreciation over time. This strategy not only cuts taxes, but also allows them to build longer term wealth faster by converting tax dollars into equity in real estate assets. The combination of the high earner with significant tax liability and a spouse eligible to qualify for real estate professional is incredibly powerful and creates a perfect synergy for tax optimization. It is a legal and effective way to offset high W 2 income and build financial freedom through real estate. Now let's move on to number two, the power couple entrepreneurs, a C Corp holding company advantage. This strategy benefits entrepreneurial couples who co-own a business together or work together in a closely held business. It is especially powerful for those generating substantial profits and looking to reduce their taxes while planning for retirement. Businesses like consulting firms, medical practices, dental offices, or marketing agencies that generate $500,000 annually or more are ideal candidates. It works by essentially establishing a C corporation as a holding company where couples can optimize tax benefits through deductible compensation, retirement contributions, and fringe benefits, and then a C corp's flat tax rate is 21%, compared to a pass-through entity like S corps, which are taxed at the owner's personal tax rate. If they have employees in an S corporation as well, there's an issue where you need to provide retirement benefits to all employees. But we can make this go away by having them not provide any retirement benefits under the S Corp and provide all the retirement benefits under the C Corp, in which just the husband and wife work together in. Then you can contribute to a solo 401k, which allows for tens of thousands of dollars to be put away annually per person. You can also take advantage of fringe benefits in the C Corporation, like reimbursements for vehicles and healthcare as well. Let's go into an example. Mike and Lisa own a digital marketing agency structured as a LLC S Corp. They pay themselves $200,000 in salaries and have $300,000 of profits left over. Rather than taking those profits and paying taxes on them completely, they can pay $100,000 of that to a C Corp, where they contribute to their self-employed 401ks and also pay their health insurance premiums. All of those expenses reduce the C Corp's income down to just a few $1,000s, saving them massively on taxes. The C Corp holding co structure allows entrepreneurial couples to leverage corporate tax law to optimize deductions, reduce their tax liability, and build strong retirement funds, allowing control the entire time. Now let's move into number 3, where both spouses have high W-2, the dual high earner and short-term rental loophole combination. This strategy is perfect for entrepreneurial spouses that still have W-2s, such as doctors, lawyers, or tech professionals who want to diversify into real estate while reducing their tax liability and don't want to go start a business. The short-term rental loophole operates under a different tax rules than long-term rentals. Per IRS Code Section 469, rentals are generally classified as passive activities with losses deductible only against passive income. However, short-term rentals qualify as non-passive if the average rental is 7 days or less and the taxpayer materially participates. If this criteria is met, losses from short-term rentals, including those generated by depreciation, can actually offset active income, such as W-2 earnings. A cost segregation study further enhances the strategy by front-loading depreciation deductions through bonus depreciation. Short-term rentals qualify for accelerated depreciation under bonus depreciation. This allows to deduct significant portions of the property's value in the first year. And unlike long-term rentals, short-term rentals can offset a W-2 income if they materially participate in the activities, creating immediate tax savings. So let's move into an example. Amelia and David are both physicians earning $1.5 million annually. In 2024, they purchased a $1 million vacation rental in a high-demand tourist area. They conduct a cost segregation study which identifies $400,000 in assets eligible for bonus depreciation. Amelia and David spend 120 hours actively managing the property, ensuring the material participation test is met. The $400,000 depreciation creates a loss against their W-2 income, and at a 40% combined tax rate, this can save them over $150,000 in federal taxes. Meanwhile, the rental generates $80,000 in gross income annually, covering expenses and providing additional cash flow. This works super well because the short-term rental is a high powerful tool for couples to not only diversify into real estate, but also create a portfolio all from W-2 income, which gets massively accelerated from the tax savings and creating generational wealth. These strategies that I just outlined are for those power couples that really want to work together and take the best of both worlds from the situations they've been dealt and really maximize their tax savings. So if you consider yourself a power couple and we're interested in working with someone who can help you implement these strategies, highly recommend you reach out to us. You don't need to be making the crazy amounts of money that we used for the examples. It's just to highlight the power of the strategies. So if you like this video, I really appreciate any sort of feedback. And if you want to reach out to us, our contact is in the description below. Thanks so much for watching. I appreciate you watching and have a great day.